Hi, everyone. Welcome again to another edition of Coleman Wealth Home Office Edition. My name is Darren Coleman, and today I'm joined by a friend, a teacher, a mentor, Larry Sarbit, one of Canada's most respected and most revered, I think, investment managers. Larry, you currently are at Value Partners Investments out of Winnipeg, Manitoba, which I know is home for you. And we sometimes tease about if this job doesn't work out, I'm going to come to Winnipeg and sell Stairmasters because you guys don't have any hills. Um, and you currently run the VPI Value Pool, which is great because it gives us an opportunity to keep working with you. And we're going to take a minute and introduce you more fully, but I think it's good if I let people know how long you and I have known each other, right? Do you remember when we first met or how long ago it was? And we can do the math. It's okay because I'm only 30 and no one's going to believe this, but
Yeah, I'm only 35. Uh, yeah, it goes back to our days at IG. At 92, I think it was
93,
92,
1993.
93, and
I
and
started and I did a good enough job that they said, "Hey, we're going to send you for advanced training in Winnipeg, Manitoba in February." And I thought, I don't think they like me. This was not a prize to win. You have a lovely city, just not in February.
not in
Um,
February.
and they
No.
sent me there as a rookie advisor to learn a bit more. And in you walked as the portfolio manager from upstairs that came down to teach us kids a few things. And you kind of blew my mind. And so since then, you've been a mentor for me, and we've had a great friendship for 27 years. Can you believe it? It's like we
No,
got
it
this out of a ring or something. It's
it
a long
all goes way too fast. Way
time.
too fast.
And so
So
since
yeah,
then,
it's a long time.
it's a long time, and you had a very good influence on me. And I mentioned this to you before. I thank you for kind of getting my head set correctly in terms of how to think about being an investor. And I know you're a Buffettologist. You know, you're a big fan of Warren Buffett. I have become a Sarbitologist, and I really believe in the Sarbitology movement. You've never heard that one before. I thought I'd keep that one in my pocket till today.
Dermatologist. You're embarrassing me.
Well, no, but your track record speaks for itself. And I know many clients over the years have had a chance to meet you when we had you into Toronto, and you've done a lot of private client events for us and spoken to clients. And now this is a way for
Right.
us to stay connected in this new world of Zoom and go to meeting things. And might be like that for a while. But we have a number of clients that have never met you before. So I think today's a good introduction, and also I think a good review for some clients. And I find sometimes when we have a talk, for me, it's like going back to church and kind of just getting back into what the religion is, right? And hearing the word. So why don't we begin maybe with kind of how you see investments, how your philosophy is that's grown over time, right? And I know some of the where I can do your presentation for you, but I think it's wise if maybe you just give a quick summary of how do you think of the world as an investor? How do you implement your philosophy?
Well, we approach investing, Darren, as if we were buying an entire company. We don't think of shares. We think of the business. Our perception is, if you were going as a private business owner, they don't have to worry. They don't think about the stock market. They don't think about the price of their business going up and down every day. They don't worry about that. They're thinking about the next year, the next 3 years, the next 5 or 10 years. Some of these companies are held in families for decades,
Right.
and uh, and so that is the kind of perception that we have of buying a share or a piece of the business. It's the same thing, exactly the same thing. And what we're looking for is very simply what Warren Buffett has talked about is companies that have some sort of sustainable competitive advantage in the marketplace. They
You give us an example of what that would look like when we talk about a sustainable advantage. Share with me an example of a company that would have that.
uh, Well, we've owned SiriusXM on and off, well, on from 2013, and we just looked at it and said there's no competition. I mean, there's radio, there's free
Right.
radio, but if you want high-end content that is in your car that you can push a button and pay every year or monthly or whatever, a subscription business that is kind of required in big cities and people who travel long distances, and they add about I guess about 1.5 million subscribers every year. And back in 2013, we looked at it and said, this is like a clock. It's just that predictable. You know that in 5 minutes it's going to be here in Winnipeg. It's going to be 10:50, and it's going to be 11:50. So
Just
it was
repeatable.
that
You just know.
it was what we call an equity bond,
Right.
which is a term that I'm surprised it hasn't been used more. But it's a company that has bond-like characteristics. Now,
Right.
as you know, equities don't come with coupons on them.
Right.
Bonds do. So what we're looking for, very simply, are companies where we can see the coupon. We can actually identify some sort of range of what that coupon is going to be for the company over the next several years.
Right.
And because if you can't do that, quite frankly, how do you value the business? You wouldn't buy a bond without a coupon. You wouldn't do that.
And yet most
If
people, that's how they buy stocks. They don't even think about the future predictability. It's, yeah, it's got an idea or it looks really good now. They don't actually look out any further than that. And actually, the SiriusXM is an interesting one because in this pandemic, I have it in my cars. I mean, it comes with the car. There's no competitor satellite radio in the car. You only get the one choice. So I've got it in my car. My wife has it in her car. I get the bill once a year, and even in a pandemic, I've already paid for it, and I'll pay for it where actually one of mine just renewed. I just pay for it again. So even the
yeah,
pandemic hasn't shut down their revenue stream, right?
no, it's a required. It's one of those. I would call it essentials. Essentials. I think Buffett's got some other terms that he uses, but you got to have it's a good product. It gives you entertainment, different entertainment than you'll get anywhere else. You want business news, they've got it. You want to listen to golf, which I don't
They've got
quite
it.
understand. I've never understood that, or hockey, or which have all kind of disappeared for the season and probably for the foreseeable future.
Well,
But
but the good news is for the Maple Leafs fans, those radio stations can keep playing replays of games that the Leafs have won, so they all feel like they're on a streak now. So that's a good news for the Maple Leafs fans, right?
yeah, well, you know what fans are like in Winnipeg. When the Jets came back to Winnipeg, people went absolutely insane. But you can listen to that. It's
Right.
on the radio, and if you want to listen to CNBC, it's there. If you want CNN, it's there. It's content you won't get anywhere else, and you get it everywhere. You
Yeah.
can be in Toronto, you can be in St. John's, Newfoundland. You can be up in Thompson, Manitoba. You
Can be in
you'll
Texas.
get
It
it.
all still works, right?
You can be in Texas. That's right.
So
So
that's a good
it
example. Now, what, but just to jump in, one of the other things, so along with looking for companies with these unique characteristics of predictability and great management, because I know that's another hallmark. One of the other things that you've taught me is that when you find these businesses, you also want to see if you can buy them at the right price. Because if you can buy them when they're temporarily inexpensive, you get a margin of safety, which I'll ask you to explain. And also you get what you kind of term this kind of two rates of return idea, which I think, especially now when we've had the markets come down a lot, that is a very interesting concept for investors to understand, this kind of two rate of return thing. So could you maybe explain the margin of safety idea, which is when you go shopping, and then what the 2 rate of return concept is.
Well, the margins of safety idea was originated by Warren Buffett's teacher, Benjamin Graham, who wrote the classic book in 1934 after the crash. Very inspirational, the crash and depression, and that's where this idea of buying a company at a bargain price, paying 50 cents, 60 cents on the dollar for a business. So that lowers your risk dramatically. You buy a great business at a bargain price, the chances of having permanent capital loss is dramatically lowered. Now it has to be a good business.
Right.
You can get into things like value traps where the businesses are questionable, but they appear cheap. The numbers tell you they're cheap, but when you look at the business, which you have to do, there are problems that maybe reflect the fact that there isn't a margin of safety, and that you're maybe even overpaying for a business. So you got to know the business, and you got to have some sort of idea of what that value is, and to be able to buy it at a cheap price.
Yeah, and I
Well
mean, all of
below.
us, and sorry, all of us have stuff in our closets we bought that we don't wear that was a bargain, and so we know the idea of making that value trap mistake.
Sure.
But if you've done your homework and you know the company's worth something, and this is something that to me is quite interesting over the years to watch, is that often we get a market correction, or we get a 2008 or a March 2020, and everything goes on sale. Many investors get very scared because they think that's when they have maximum risk. But actually, what we try to teach clients is that that's when risk just left the investment, right? When it's
Correct.
already gone down, all the risk came out of it. And that's when you should really be looking for where the values are. But you've got to have done your homework in advance, right?
Well, it's a lot like buying everything else that these investors buy, whether it's a car or a loaf of bread or gasoline. They're always happy when they walk into the store and the price is half price or
Right.
2 for 1 or whatever, or the price of gas has dropped, which it has significantly across the country. We won't go into the
Right.
rationale and the
Yeah.
reasons, but that's happened, and people were happy to pull up to the pump and pay. I don't know what you're paying there, but we're paying around 83 cents a liter here right now. And that's come down from $1.09 or something like
Right.
that. So
Right.
so we're happy to enjoy that and take advantage of that for as long as possible. And everybody understands that. Every single person understands that if you can buy um, uh, toilet paper at Costco and
Right.
there's $5 off, you buy
It's a
it.
bargain. Right. You buy it.
Yeah, you buy it. So except stocks, as you rightly point out, yeah, if they are happy to pay more and they're unhappy to pay less. It makes no sense
Exactly.
whatsoever. It's irrational, but they think somehow the stock price is going to continue to drop to zero or something ridiculous like that. They're going to have a permanent loss of capital. If you bought it at a cheap price and it goes down further, what we like to do is buy more.
Mhm.
Uh, Buy more, just as you buy anything in the grocery store at a bargain price. You don't buy one of them. You buy 3 or 4 of them, right?
Right.
Whatever it is. If it's toilet paper, I mean, I've driven down there. I'll tell you a funny story. I used to have a Volkswagen Beetle convertible, and I'd go to Costco, and they have uh, uh, toilet paper on sale,
Yeah, and they're
and
huge.
I'd buy 4 of them, and I'd have to take the top down, and I don't embarrass easily. So I'm driving down, the road, and people can see what I have in the back of my car,
And they can see
and
you.
they could see me, and I don't care.
You
I'm
got a
not
bargain.
embarrassed at
Well,
all. I got a bargain.
I was gonna say you and I've joked before about how everybody you can always get something wholesale. I don't know if that's a Winnipeg thing or whatever, but
That's
you
a
all
Winnipeg thing. It was built on wholesaling and transportation, and it was the major stopping point for everybody going west. And wholesaling was a huge business here. And yeah, everybody knows somebody who can get you into a wholesale and get you a bargain,
well, and I
right?
think that comes your family was in that business, right? So maybe you got programmed like at birth to know how to do this stuff. This came with language,
Well, I grew up in a grocery store. My dad
right?
was a grocer, and it takes immediately, this idea of, gee, I can buy, 3 bottles of ketchup. He'd put it on sale. He'd buy it cheap
Yeah,
from Heinz or whoever, and he'd pass it on to the clients to attract them in and buy other stuff at sort of, full prices, but they came for the ketchup,
right.
and they came for the ketchup, and they bought 3, and they bought it at a bargain price. It's instinctive that people understand paying less. Only in our business is this turned upside down. It's
Yeah, well,
inverted.
exactly right. And usually there's this momentum strategy that some people have where the more expensive it gets, the more they want to own it, which is the exact opposite to the logical approach that you have.
Exact opposite. Yeah.
And they add risk when
And
they,
yeah.
if risk
And
is
and the
going up.
margin, yeah. And you mentioned, it's funny you mentioned that, the double dip, as Warren Buffett termed it way back, I think in the 1980s or something, in one of his annual reports. And to me, it just punched me right in the head. It was this idea that if you buy a business that is growing
Hmm.
at 10% a year,
That's trend,
and you buy it for half the price or three
right?
quarters of the valuation, eventually the will stock price will recognize the value of the business, and you get the growth of the business. So you
Right.
get 2 rates of return, not one. And he turned the double dip because he loves ice cream, and so it was a double dip concept, and it was his idea. You get 2 rates of return when you
Right,
buy
because
a great
you've
business.
got the rate of return of the business over time, but if you can buy it here, not here, you get the return to
Correct.
here, and then you get this. So it's
That's
like
correct.
that, right? So you kind of get that
Yeah,
first return back to what the correct valuation should be. Then you get that longer term return, which is the organic growth of the business. But you don't get many chances to do this, do you? And this is one of the challenges for people when they play the home game is at the time of maximum opportunity is often at the time of maximum fear, right? And so I
absolutely.
remember, and I'm going to quickly tell the story because in 2000, you and I had a chance to work together again because you've been an investors group, then you moved out of their kind of closed infrastructure. And I remember being at Nesbitt Burns at the time, and you'd launched a new series of funds, and you came into the big office at Nesbitt Burns in Toronto to do a meeting, and it was me and I dragged another guy in the room. No one else knew who you were. No one else paid attention. No one else showed up. Um, and you went into the 1999 2000 period with a portfolio that was almost completely in cash. And I remember at the time that wasn't a call on the market. It's just you couldn't find anything that kind of matched the discipline of trying to find great businesses at a reasonable price. And then we went through that period, and all of your competitors running US equity funds and ETFs, they all lost 50 to 70% of their value. And here you are, and I look like a genius because I put you in our client portfolios. You've got cash. Your portfolio not only didn't go down, you went shopping. And while everybody else had negative 30, 40, 60% numbers, you had like a positive 30 because you bought everything on sale. Like, I looked like a genius, but all I had to do was know you because you were the genius. So
Well,
I've had that experience, and we've had it a couple of times together where when everyone else seems to be losing their marbles, you are the smartest guy in the room. So let me move forward to where we are today. And we've had a crazy market, we've had a pandemic. A lot of people are not sure what to do next. They're not sure what the next thing to come is. How are you in your portfolio approaching this? Are you worried? Are you worried about the virus? Are you looking for opportunity? How do you apply that discipline that's always worked out for us in weird times? How are you doing it now? Or is it same
well,
as it ever was?
I think I know as much about this virus as everybody else on the street. And the answer, Warren Buffett at his last annual meeting on May the 2nd,
Right.
uh, 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 we counted up the number of times he said, "I don't know," and it was about 30. So and Charlie Munger, who's the vice chairman of Berkshire Hathaway, was saying the same thing. We simply don't know what this is, how long it's going to take, and we've gone instantly into a quasi depression where 20 how many millions of jobs have been lost. I think we're 20% unemployment or something. I was just instant,
Right.
and it looks, there's a lot of comparisons to the 29 crash. It was all financial at that time. The
Right.
crash of 2008, the crash of 2000, they were all financially related. This is a different kind of animal in
Yeah,
that it
this is
is
Main
it
Street, not Wall Street, right? This is hitting people right where they live.
yeah, and how long this will take, we don't know. So, but the way you approach this, the way we've approached this, is by saying, let's find companies that are going to be required, that you need. So, SiriusXM is an example.
Oh,
T-Mobile,
yeah, that's one I know that you run.
T-Mobile, which is merging with Sprint. They'll be the second largest. They call themselves the uncarrier, uh, uh, but they're the cheapest subscription out there. They're building out a 5G network. Uh, you can't take your kid's cell phone away. It's highly dangerous trying to. I mean, you're not going to cancel that. It's going to be the last thing you're going to get rid of. That and your cable network and your Wi-Fi. If you get rid of that, your kids will leave home and go to somebody else's place where they do have cable.
Well,
It's
someone
an
asked me,
essential.
yeah, so
It's
someone
a
asked me,
utility. These are
someone asked me today, they said,
utilities.
how are you guys doing at home? Are the kids okay? And I said, look, I'm not worried about the virus, but if this Wi-Fi goes down, it's gonna get bad real fast, right? So I'm more worried
Yeah,
about
they're going
that.
to have to read books for
Can you
entertainment.
imagine?
Can
That
you
would be horrible.
imagine?
That would be horrible.
So,
So, so,
so,
so
so
that's so
those
you
kind
so
of
you look for those companies. Sorry to interrupt. You're going to look for those companies, and then one thing I think that's also a hallmark to what you do that I think we should mention for investors is how you think about diversification, right? Because we see some portfolios, some ETFs, they just buy everything under the sun and hope that something works, and it's about being more or less right, but not really wrong. You run more concentrated portfolios, and I think that's a very interesting aspect to what you do that people need to know. So tell me a little bit about that.
Well, think again about a private business owner. They don't own 50 businesses and run them. They own one, two businesses. That's how you make a lot of money.
Right.
That's how all great fortunes have been made in things like Google, which we own, by the way,
Hmm.
because it's a franchise. It's irreplaceable. But the guys that created that made a fortune in one business. Okay,
Right.
made a fortune let me think of another good example that we own. Berkshire Hathaway.
Yeah,
You
those are good
know,
ones.
he now he's got about 70, 80, 90 companies today, but most of his profit is made in insurance,
Exactly.
catastrophe insurance, and also in auto insurance, Geico, which he owns, and that's where and he owns Burlington Northern, which is I think the second largest or largest railway, intercontinental railway in the United States, and it's an absolute requirement. What else do we have? ADT.
Yes, very
ADT.
people.
Uh, People do not disconnect their home security or their business security system, even if their shop is empty right now. There's
Right,
nobody coming to the shop, but maybe your insurance requires you to have some sort of security, and you're not there all day.
right,
So the last thing you need is somebody to break in, and you don't have a system where the alarms go off and the police are phoned, and the fire department and all the rest of it is taken care of for you. That's what you pay them for, and you pay them every month.
right. Again,
We
that
love
subscription model, this clockwork.
this subscription model. You pay for your cell phone over and over and over again. You pay for your cable over and over again, and go ahead, disconnect it. See how happy your family is. We're looking for things that people can afford and that people require,
Right,
and where they have a dominant place in the market. So T-Mobile is now the second largest cell phone company, and they just keep growing. And it's an oligopoly. There's basically three national suppliers. There's AT&T, there's T-Mobile, and there's Verizon.
right.
That's pretty much it. And now that Sprint has joined T-Mobile, that took one of the big competitors out. So, you don't have a lot of choices, and you're going to go with the one that is supplying you a good connection at a very good price. So,
And you're right, you don't find that many of these kind of wonderful businesses. So, and one of the neat things about your portfolio is that when you do find them, you focus on them. You don't have hundreds of. I don't think I've ever seen you own more than maybe 20 businesses in the portfolio ever.
yeah,
I can also tell people that from time to time we have access to some software that lets us X-ray different fund portfolios. And over time, and I don't do this as much anymore, but sometimes I would take a company that you own in your portfolio and I would be curious to see, I wonder how many of your competitors own the same security. And many times I discover nobody. Like you're the only guy with the idea. And I'm like, that's curious because I would think like the Fidelities and the Mackenzies and the Templeton, like they would have all jumped. No, quite often you're the only guy in the room owning it. And that's, I think, also interesting for us as portfolio managers too, is we can put your portfolio in and it doesn't overlap with anybody's. And then
right.
there's another, so along with finding wonderful businesses and concentrating on them and trying to get those two rates of return, you're also very patient. And I think this is another hallmark to what you do. And you and I both know that this has been contentious tremendously in the past, which is if you don't find a good idea, you'll just hold on to your ball and go home. Like you will just hang on to cash, whereas
Correct.
I think most investment managers, their attitude is I have to keep investing money no matter what. And if I can't find a great idea, I'll just buy my least bad idea. Um, but you don't do
Yeah,
that. You have a very different view, right?
and overpay for them in
And overpay for
expensive
them.
market, and that's a bad combination. So that's why guys like Buffett are saying the alternative for most people who want to participate in the growth, the long-term growth of America, which he believes in and I believe in, even though we're going through a very interesting, tough time, is America will come out of this.
You'll figure it out.
And and you want to be in, you don't want to, you want to be in the businesses that are going to be surviving
Right.
Okay, no matter how bad things get, they will come out of it stronger and in a greater position than they were before. So how do you knock off a Google? Okay, how do you get rid of it? You know, we put together a list of great companies and said, where's the competitors? So RBC, they've got competitors, right? Coca-Cola has competitors. Sobeys or Superstore, they have competitors. Google has no competitor.
Right. They
There
all die.
is
No
there
one uses
there's
Yahoo anymore, and Alta Vista and Web. These are all dead. They're gone. My mother calls it
well,
the
there used to be
worst world.
Ask Jeeves. Do you remember that one?
Yeah, it's gone.
I mean, and
It's
there's
actually
so
probably still
there's
around. I'm gonna
yeah
Google
so
it and see if
so
it's
there's
still there.
great. It's become like Kleenex. It's
Yeah.
it's it's be- it's become the generic name.
Right.
It's like it's become a verb. It's become an adverb. Google, and it's what you use to search. And how many their revenues keep growing and growing. They make more money than we figured this out. Target, Pepsi, McDonald's, and Walmart. They make more money than all those companies combined.
Wow.
Okay. So and they're sitting on a few $100 billion in cash, and they keep. It's a low cost business
Yes.
to be in. You don't have to pump a lot of capital into it. They make a lot of money off of advertising.
Yes.
They own YouTube. They own Android.
Well, and the
It
more
just
people
goes
use it,
on and on.
they get
It
right.
just it's and normally, I mean, it, being an old guy, it took me a while to really grasp uh, the concept of this is a powerful franchise in a number of areas. And in search, that's what people use. People Google the answer, right?
Yeah. Well, as I
YouTube,
mentioned, my mother thinks it's a noun because she calls it the Google. So that's
well,
she's playing with
whatever, but she knows,
it. Absolutely. Yeah.
everybody knows the name. And
Yeah, I'm gonna
uh,
Google and see if Ask Jeeves is still around. That seems kind of a punishing thing to do.
so it's indispensable. And if you're sitting in your house and you can't get out, you're using more of it. You're
Absolutely.
watching more YouTube. Your Android is the biggest phone
Platform.
system out there. Okay, it's just and they really haven't monetized that yet. So they're not earning very much off of it, but they could easily tack on a fee to the manufacturers
Yeah.
of Android phones and say you're now paying us $3 for every phone,
Well, it's like
and we're
Qualcomm.
talking of billions of phones,
Yeah,
right?
because Qualcomm sort of did that when they, if you want their chip, you had to buy. You wanted to make a phone, you had to buy their chip. Microsoft did it. If you want to sell a PC, you got to pay for our software. So you're right. That's a whole other revenue stream they haven't even capitalized on yet. That's all sitting there
Yeah.
waiting for them to take. But I
Well,
think the
yeah.
overriding message from this, sorry to interrupt, is because I know we're almost. I've really taken a lot of your time today. I think
Uh,
one of the big
that,
messages that I've always found helpful with you, and I know when you shared it with clients, the feedback I get from clients is fantastic. Is this logical business-like approach to investing, which ought to be timeless, right? You'd think that everybody would follow these obvious, logical,
yeah.
prudent ideas, but yet very few do. And Warren Buffett is probably the most quoted but least followed investment manager. People quote him all the time, but rarely do people implement the discipline. And I'd say that also is what makes you unique, why I'm a Sarbitologist, right? You follow very similar practices. People understand it, but yet the doing of it is the hard part. And I will tell everyone watching after 27 or 28 years of knowing you, you actually do it. And so thank you for sticking to your disciplines. Thank you for being a great mentor and a guide to me. And I know our clients have profited immensely over the years. And I think especially in times like now, the style of which you invest, the discipline and the logic is always valuable. And I think it actually gets repeated again in times like this. So thank you very much for doing what you do. You're not allowed to retire. You're not allowed to do that to me. So you
I
got to
don't
keep.
want to retire. My model is Irving Kahn, who was Ben Graham's first teaching assistant, who died a couple of years ago at 109, and he was still working. I knew his son, who said, "Dad," and he was himself was in his 70s or something, 70s or 80s. Said, "Dad is there when I get there in the morning, and he's there when I leave at night." So it's 109. A lot of these guys last forever, seem to last forever. Buffett's 89, Charlie Munger, who's, I mean, these guys are all, multi-billionaires, and they're doing it because they love it. It's actually fun. I don't know what else I do. To be
Well, I don't
honest,
want you doing anything else, so don't go start a band or anything else. You keep doing this, and that'll keep you young and keep you safe. So that's important to me too. Larry, I'm going to close it
Okay,
there. You've been very generous with your time. I really sincerely appreciate it. I
thank
appreciate the
you.
relationship you and I have. I know you're always available to me and for clients that when we need to know something. We don't abuse it, but I do really appreciate your friendship and your guidance. As I say, I was very blessed that you were the very first portfolio manager that I ever got to meet as a young guy in the business, and that has stayed with me and really helped
Uh,
us immensely. So thank you.
I'm blushing, if you can see on the camera. We're in interesting times. We'll get through this. I'll just add, we're sitting on
Sure.
about 50% cash. Uh, we're not alone in Stan Druckenmiller, who's
Yeah.
worth around $5-6 billion through investing, has said he has never seen risk reward calculation for equities. He says it's the worst he has seen in his lifetime. So we need to protect, first and foremost, you always protect the client's capital. And then when people recognize that the prices are ridiculous and they come down, as I'm not predicting that, but I'm saying if that happens, we've got the money.
Right.
We've got the dry powder to be able to take advantage of it. So we're looking for money. We're
So
looking
we're
for
gonna get.
money.
I can just see you in the convertible with all the stock certificates in the back after this, right?
Well,
Get a price fixed.
we hope to be able to fill them up at Costco prices.
Right.
So
Well, we'll be
that's
there when you do. We'll be there when you do. Larry, thank you very much for your time today. I'm going to close off our recording, and always a pleasure. And remember, the
likewise.
measurement is one hockey stick from everybody else. Give them a poke check if they get too close to you. And the refs aren't calling anything, so you can just hit them. It's all good.
All right, will do.
Okay. Be
You
well.
you
Thanks,
be
Larry.
well. Take care.